China's transformation into Africa's largest trading partner is one of the most important and least understood economic stories of the 21st century, and it explains a massive shift in global power that directly affects the United States, global markets, and the future of trade itself. At the start of the 2000s, Africa was largely ignored by major global investors. It's written off as too risky, too unstable, and too slow-growing. While Western nations focused on the Middle East, Eastern Europe, and Asia, China, however, saw Africa differently, not as a charity case, but as a long-term economic partner. Beijing recognized three things before almost anyone else. Africa had some of the world's largest untapped natural resources, fastest-growing population on Earth, and an enormous infrastructure gap that Western institutions were unwilling or unable to fill quickly. Instead of approaching African nations with lectures about governance or democracy, China came with offers that were simple, practical, and immediately useful: build roads, ports, railways, power plants, factories, and digital networks. And in return, secure long-term trade relationships, resource access, and political goodwill. Over time, this approach created a powerful economic ecosystem. Chinese companies built thousands of miles of highways and rail lines connecting landlocked African countries to ports, dramatically reducing transportation costs and unlocking trade potential that had been trapped for decades. Massive port projects in places like Djibouti, Kenya, and Nigeria turned Africa into a key node in global shipping routes, linking Asian manufacturing directly to African and European markets. At the same time, China became Africa's top buyer of oil, copper, cobalt, iron ore, and agricultural products, resources essential not only for China's domestic growth, but also for global supply chains that feed American industries, from electric vehicles to consumer electronics. By the early 2010s, China had surpassed the United States and Europe to become Africa's largest trading partner. And today, that trade exceeds $280 billion annually, dwarfing U.S.-Africa trade by a wide margin. What makes this relationship especially powerful is that it goes far beyond raw materials. Chinese firms operate industrial parks across Africa, helping countries like Ethiopia, Rwanda, and Egypt move into light manufacturing, textiles, electronics assembly, and automotive components. These factories employ millions of Africans, integrate local economies into global value chains, and create export capacity that did not exist before. For African governments, the appeal is obvious: fast development, visible results, and fewer political conditions. For China, the payoff is long-term influence, diversified supply chains, new consumer markets, and strategic positioning across an entire continent. Critics in the United States and Europe often frame this relationship as debt-trap diplomacy, arguing that China uses loans to gain leverage over African governments, but the reality is more complex. While debt risks do exist and some projects have been poorly managed, many African leaders actively chose Chinese financing because Western alternatives were slower, more restrictive, and often focused more on risk avoidance than development. China filled a vacuum left by decades of Western hesitation. From an American perspective, this shift is deeply consequential. As China builds trade networks, logistics hubs, and financial ties across Africa, it is also shaping standards, technology adoption, and political alliances that may last for generations. Chinese telecom companies build digital infrastructure, Chinese banks finance trade, and Chinese currencies increasingly appear in cross-border transactions, subtly challenging the dominance of the US dollar. Meanwhile, African nations once firmly aligned with Western institutions now pursue a more balanced foreign policy, leveraging competition between global powers to their advantage. This does not mean Africa is owned by China, but it does mean influence has diversified, and the era of Western economic monopoly is over. For American audiences, the lesson is not simply that China won Africa, but that global leadership in the modern era is built through trade, infrastructure, and long-term partnerships rather than military presence or short-term aid. While the U.S. focused heavily on security cooperation and humanitarian assistance, China focused on commerce and connectivity, and over time, that strategy reshaped Africa's economic landscape. As Africa's population is projected to double by 2050 and its consumer markets expand rapidly, the foundations being laid today will determine who benefits most from that growth tomorrow. China understood this early, invested aggressively, and accepted risks others avoided. The result is $280 billion Australian dollars trade hub that is not just about Africa or China, but about the future of global power, supply chains, and economic influence, and it raises a critical question for the United States. In a world increasingly driven by infrastructure, speed, and strategic trade, can America afford to look away again?